Hey guys, back again with another video, and this video is actually about the intro to technical analysis, market structure. You can actually go ahead and follow me at MarketWatchFX. You can add me on Instagram, and you can comment, share, and subscribe, okay? What will be covered in this video? Four types of charts and the chart movements, market structure, and then on top of that, the major movements and the minor movements in the market, okay? So, what are the four types of market movements? The reason I said there are actually four types is because it's the market's usually trending up or down 30% of the time, but 70% of the time the market's range bound. So it's stuck in structure or it's stuck in some type of area of consolidation, okay? So therefore, there are four, and I'll restate them again: trending up, trending down, range bound, and consolidating markets, okay? So for trending up, it's usually higher highs and higher lows, and it's usually the markups of the market. So therefore, the reason that I actually have this chart over here is to show a comparison to the last webinar or video that I actually presented, because I said that in the Wyckoff's theory, it actually presented a case where there are four types of things that happen in the market, which is the accumulation, the distribution, the markup, and the markdown. So this would actually be considered a markup. So go higher high, higher low, higher high, higher low, higher high. Okay. And this is actually another chart that can show what happens when the market is actually making a reversal. So therefore, higher high, higher low, higher high, higher low, higher high, higher low, and then look right around here. So this area around here is the reversal pattern. It's typically a head and shoulders, a double top, double bottom. It's typically followed after a harmonics pattern, some type of structure, and it's always around this area when the market reverses. And then actually this will show what will happen after, which is the trending down or downtrend, okay? So immediately after the reversal, there's something called a downtrend, which is lower highs and lower lows, lower highs, lower lows, lower highs, lower lows. That's typically all you really need to know in regards to what is a downtrend. Pretty simple, right? And this is the range bound market. So the reason I said that there are four is because the range bound market is something that happens all the time in Forex. It's basically intermediate waves in a consolidating pattern on a higher time frame. So you put your support and resistance, and then you wait for a breakout, or you could just trade the levels up down, buys at support, sells at resistance, okay, until the breakout occurs. Consolidating markets. It's basically little to no movements, and I'll actually go back to the range bound, and let's see if I can go back. Whoops, not available. But it's usually followed with tight consolidation, and it's usually before news events. It's usually when the market's at structure. It's usually on a lower time frame when the market's at structure, and you're actually just waiting for a breakout towards the upside or the downside. So to your right, this is actually an example of what tight consolidation looks like. Little to no pip movement, okay? And what is the definition of market structure? Um, the definition of market structure, in my opinion, is referring to the evolution of market movement, where market movements, in a sense, on average, go up or down. So therefore, I use sort of like a bearish Gartley to depict what an average market movement would look like. So X to A would show what? A downtrend. And then A to B would be an uptrend. And then B to C would be a downtrend. And then C to D would be an uptrend. And it will be immediately followed with a downtrend. So therefore, based on what we've learned, the downtrend consists of the lower highs and lower lows. The uptrend consists of the higher highs and higher lows. The downtrend consists of the lower highs and lower lows, and then after that, higher highs and higher highs and higher lows. Sorry about that. So the reason I also showed you the bearish Gartley is because everything's a process, and over time you'll get to the point where you'll be looking for these patterns and looking for good situations to enter and exit the market. So another thing that I wanted to show you with this chart specifically is look at the D point, look at the B point, the C point, the A point, and the X point. So the X point is an uptrend previously, probably retested some type of structure, and then it retests one more time. And this could be considered a double top and then went into the downtrend, right? Another thing that you could have entered, two ways you could have entered was aggressively right over here, or wait for the drop, look for a retracement, look left, and enter at the new structure. Another thing that could have happened is right over here, there could have been some type of spike towards the market. So at the A point, the market just dropped due to this X, and it hit some type of structure once again and spiked, and this spiked towards the upside with a big wick or a big candle, and then it just immediately just kept doing a uptrend. Okay, and then you look left, and then you see some type of structure, and then it's added with Fibonacci or some type of secondary structure to say, hey, this is a valid point, and then right around here, another spike towards the market or market exhaustion. Go back down, the C point, head and shoulders pattern. And you can actually zoom in if you would like to see more information. But then it goes up to the upside, and then it's, an uptrend. And then lastly, the D is followed with a double top, and it drops. Okay? And this is actually a 450 pip move, so that is pretty cool. And I would say if you put structure with just the simple principles of supply and demand, and you put it with just understanding what an uptrend and a downtrend looks like, you can find these all the time in the market. Okay? And this slide is actually another depiction of how to see market structure. So this is more detailed because this isn't a lower time frame, but this is typically what market structure looks like when you're marking your charts. So these are micro waves. So the main wave would be high to low, but the microwave would be just higher highs and higher lows. You see how it's just arrows in showing the dips and rallies. So therefore, you go up for the reversal after you hit this point. This is probably structure, and it goes up and it retests, previous resistance, goes back down, retest previous support, and it shows some type of reversal. Okay, and it just goes back up into the uptrend. But that's another thing that you can do to kind of gauge where price is at. Just mark up your charts with just arrows. It's very simple, it's very effective, and that's it. The next thing that will be covered is support and resistance, trend lines, and zones. And I would say the reason that this will be covered in the next video is because we always need some type of support and resistance in regards to gauging where the market is at currently. And then we also need trend lines to depict the overall movement. And we need zones because at the end of the day, price depicts off of history of previous price movement, but it doesn't always hit the same price movement. It's always in a range or in a zone. So therefore, that's why we use zones. And I'll show you how you draw your zones. I'll show you how you use your trend lines, and I'll show you some support and resistance strategies, okay? But Thank you for your time, guys, and have a great afternoon.